Another day of stock market freefall. Let's have a look and see what's going on here. It's Friday. We've seen a little bit of news hit. Let's look at a couple of key levels and setups. I'm Jared Johnson. Good to see you guys. Let's have a little peek at this stock market. All right, let's dive right into the charts and just see how everything is playing out. So far, right now, these are important things to keep an eye on. This is the S&P. So far, we have seen a low of 16.8% off the highs. It's pulled back just a little bit, but another big down day, 4% down in the S&P. Now, remember a couple of important levels to watch for. We're looking for 10%, we're looking for 15%, and we're certainly looking for 20%. So, corrective market, kind of the midway point, and bear market, which is 20%. So we're just past that midpoint, creeping a little bit closer into bearish market territory. Now, there's a couple of things that I want to bring up and look at here when we talk about kind of corrective markets versus full-on bear markets and so on. Let's go to a slightly bigger chart here, and let's look at some of the past sell-offs. And I'm just going to go to SPX, and let's look at some of the past sell-offs and kind of what they've meant. And we're going to look at policy change. We're going to look at policy change versus, we're just going to call it natural, right? Versus natural selling. And so when we look at kind of these two comparisons here, this is a policy change move, right? Now, there's always reasons for market selling, and they just usually need a catalyst, and the catalyst in this case has been a policy change, right? This right here as well. Here is the high of 2022. This is a policy change, right? We see a high to low of about 27%. This is interest rates getting the biggest hike in the fastest pace that we have seen probably ever, I think. So policy change in the 20-ish% sell-off. This, not a policy change, right? This is COVID, and COVID was a surprise. All these things happened there. About a 35% sell-off, right? This was non-policy change. This was a natural occurrence. This right here, this is 2018. This is a policy change sell-off. What do we see there? Right about 20%. This is the Fed trying to raise interest rates. The market got scared, the Fed got scared, and then nothing ended up changing. So policy change, we see a 20% sell-off. If we go back a little bit further here, we see, let's just go to some of the big ones here. This is some policy change, right? This is an 21% sell-off, policy change. Let's go right here and look at 2008, right? 2007, 8, 9. This is a natural sell-off, 57%. What do we see just before that? No change in policy, just a normal everything broke. This is .com, right? 50% sell-off. So we see just at least since about 2000, in the last couple of decades, the policy change moves are actually a lot less severe than something breaks and everybody freaks out, right? Something breaks, totally unexpected, and it's a mess. We see, anywhere from 35 to almost 60% dips in the S&P. When it's a policy change, we tend to see kind of more in the 15 to 25%. So remember, this is a policy change movement. I'm not calling a bottom. I'm not calling any kind of, what kind of dip we may see here. But when we see policy change movements versus something breaks, those tend to be and can be twice as large as a policy change movement. This is policy change. Tariffs were enacted. They could be reversed. They could be negotiated. They could be changed. And in fact, we have seen in the news this morning, some trade partners, China is digging in its heels a little bit. There have been a few other countries that have already reached out and said, you go to zero, we'll go to zero. So we can see that there is some negotiating starting to happen, but policy change selling versus not policy change selling seems to be drastically different. Let's look at this guy right here. This is one we've talked about quite a bit. This is the VIX, and this again is how desirous are people to hedge and protect their portfolios. Pretty strong there. Obviously, with what we've seen, no surprise to see the VIX going above that 28, 29 level, and it's up there by a long shot. Now the question is, How long is the VIX expected to stay up here? How long will it stay up here? We don't know. We don't know. There's not enough answers right now to how the tariff news will be handled to really determine what the VIX might end up doing. But you can see here, the exception of, this is obviously COVID, this is 2008, and this was, panic in the middle of 2024 as the carry trade unwinding, so on and so on. But when we look over here, we don't see a lot of time in or above kind of the mid 40s, right? Even with things as crazy as COVID, as crazy as 2008, we don't see a lot of time spending above this kind of mid 40s level. So the closer we get to that, the more beneficial it tends to be to start looking for S&P exposure, because as this goes up, the S&P continues down, and we don't, we don't see this get too much above this area here. So just a couple levels to watch. You can go and comb through the charts. I mean, we have big challenges in some of these companies. Lulu, for example, which of course has all of their products made overseas, and we see, we're getting back to, COVID levels are way back here, right? All the way back at $129 a share. We're just getting back to kind of, August levels in Lulu. Nothing too crazy. We're sitting at kind of, bottom of 2022 interest rate hike levels. So I want to look at all these. I want to keep an eye on these ones that seem like they're most exposed to tariffs and to overseas manufacturing. I've been talking about Nike quite a bit. Look at Nike. It's up 4.5% today. How interesting is that? Nike's at an interesting area along with, we go back historically, this is like owning Nike in 2014. So this $50 level is a pretty interesting one, and it's coming off that with quite a bit of strength. So watch these levels. Couple of things that we want to keep an eye on as well with this kind of a market. There's a lot of fear of the dollar index weakening. It's interesting to see the dollar index bouncing here. We're seeing a little bit of bounce in the dollar index. But again, the levels of the dollar index right now, of at least the last couple of decades, the dollar index is, 3 to 4 decades, the dollar index is still in the upper portion of that range. So it's still in a really strong area. And then, of course, what everybody wants to watch is the 10-year yield. And that 10-year yield is looking pretty, it's down pretty good. We're sub 4, 10-year yields coming down. So things are happening. We'll see how this plays out. More answers need to come before we can ultimately determine where the bottom is, where we're going to be seeing the selling subside. But right now it's a big red day, but hopefully this helps you put into perspective what we're looking at and where the market might slow down, calm down, find a little bit of footing. Good luck, everybody. Happy trading.